almost every country in the world is running gigantic budget deficits. And so people are looking at this and they're saying to themselves, okay, wait a minute. Government spending is out of control worldwide compared to revenues, and nobody's doing anything about this. Inflation's above target, and the central banks are easing policy. So investors are concluding, okay, we want assets in our portfolio that central banks cannot print. And the thing is, the amount of equity and bond assets around the world is huge. And so even if a tiny portion of that gets reallocated to precious metals, which are much smaller markets, it can cause a huge move in prices. And gold has been the leader in that regard.
Today's episode is brought to you by Teucrium. Learn more about how agricultural commodities can play a role in your portfolio by clicking the link in the description. Very happy today to be joined by Erik Norland, Chief Economist at the CME Chicago Mercantile Exchange. Erik, great to see you. Welcome to Monetary Matters.
Thank you so much. Thank you for having me.
Erik, of course, we're going to talk about macro, your outlook on inflation, the Fed, interest rates, labor market. But, I'm talking to someone from the CME. I've wanted to ask guests about this all the time. I'm so interested in it, and I finally have the opportunity. It's finally appropriate. Silver. What is going on with silver? Just over the past year, it's up 80%, even more than gold. It is an extremely interesting metal for a variety of reasons. Why is it so interesting to you, Erik? You've done a lot of work on this. And how are you interpreting the supply-demand balance or perhaps imbalance that is causing such extreme price action?
Yeah, so there's a few things to know here. First of all, silver is highly correlated with gold on a day-to-day basis. The correlation over, say, like a 1-year rolling period varies over time, but it's always very strong, usually between about 0.7 and maybe zero point 0.9 positive correlation, which is very strong. Secondly, to borrow a term from the equity universe, silver is kind of like the high beta version of gold. So typically, if gold goes up 10%, silver might go up like 11 or 12%. So it's not too surprising that in the context of a gold bull market, silver is outperforming. But there are other reasons why it's outperformed as well, beyond the kind of correlation structure of the market. And the main reason is technological. When smartphones came onto the market, it was very, very bad news for silver. At the beginning of this century, in the year 2000, a quarter of the world's mining supply of silver was used to develop photographs on silver plates. I know this is hard for young people to understand, but like back in the 80s and 90s, you had essentially rolls of film in your camera. And when it ran out, you had to take it to be developed on silver plates at like a local, at the shopping mall in order to get your photos several days later. Um, that demand got wiped out. But silver is finding lots of new demand. So it's having soaring demand from solar panels. And there's gigantic numbers of new solar panels being sold around the world, particularly in China. And then secondly, it's also a component in batteries. And so battery usage is exploding as people need to find a way to both power mobile devices as well as store energy from intermittent power sources like wind energy and solar.
And so that photography demand had been declining for a while, and it basically has been, practically zero for so long. One thing that stood out to me, Erik, looking at your research as well as from the World's Silver Institute, is just that now it's no longer the demand from photography is declining. The real decline is the recycling from photography. So that recycling that would go back into the new supply is actually going down. So that is causing supply to go down even further. And you touch on something. So gold, the vast majority of gold is as a precious metal, as a reserve asset, as a financial asset. It has industrial uses, but they're very limited. Silver is both a monetary metal as well as an industrial demand. And then another thing, Erik, that's very interesting to me and interesting to a lot of people who look at silver is that a majority of the production of silver mines is not an outright silver mine. It is a mine where silver is a byproduct, whether it's a zinc mine, a gold mine, or a copper mine. So silver supply may not be super elastic and responsive to the price. So if the price of zinc goes up 10 times, you can bet that in the next few years, supply is going to respond to that. Whereas silver, that response may be a little bit more muted.
Yeah, I think that's absolutely right. And the thing is, certain industrial metals like copper right now is relatively expensive by historical standards. but a lot of industrial metals are trading at pretty cheap levels, like iron ore, et cetera. So the incentive to go out there and do new mining that could result in a silver byproduct is not consistently very high.
That makes sense. And so, uh, tell us about a lot of the things that you say could have driven the price of silver, the high demand for industrial uses, the low recycling rate from photography. That's true, but it was also probably true a few years ago. Like, what is it about now that is causing such extreme gyrations, mostly to the upside?
Yeah, so and the good news about photography is you can only die once. So the fact that it's almost entirely gone, means that that source of demand really can't decline much further, or even if it does decline much further, it really doesn't matter very much. In terms of silver demand. On the other hand, solar panel demand is soaring, battery demand is soaring, so it is finding these new uses, and those new uses are still generating a lot of activity. And then lastly, investors saw gold becoming so expensive relative to silver as well as platinum and palladium. And I feel like a lot of them needed to find sources of diversification. The world produces 100 million ounces of gold per year, but it produces around 8 or 900 million ounces of silver. So silver is kind of the next market that inflation related demand or inflation fear related demand spills over into.
And Eric, so I earlier I quoted the World Silver Survey, and they clearly have a bias to promote the purchase of silver. You and the CME actually are very neutral, and you just want to have a clean, orderly a way to get exposure to these assets. But when people talk about how they calculate supply and demand for silver, like the way the World Silver Institute do it, and maybe other silver bulls do it, they always calculate uh, people buying silver in order to put it in coins or bars as part of demand. But to me, that seems a little artificial because if that were to reverse and people were to sell their silver and melt it down and sell it as they did throughout the 1980s and 90s, I believe, then that would be that whole thing would reverse. So when you look at the demand for silver, like are there are you are should the silver bulls be worried about millions of silver holders around the world who, let's say the price doubles to 105 $110, who are going to be sellers and melt down their silver and stop buying silver bars and coins? Or does the behavior of history actually indicate the opposite, that actually the higher the price goes, the more individual demand for these products goes?
Yeah, I would think it would be more the latter. I mean, I think that investors tend to chase performance. And so it would not surprise me as a result of this year's spectacular performance of silver to see a lot of inflows into silver ETFs, which basically just sit there and stock silver on behalf of the investors. Now, at some point, the trend could change and then you could wind up in a psychology of selling. What was interesting about the 80s and 90s is that the price fell very sharply at the beginning of the 1980s, having something like an 80 or 90% price drop. And then it just stayed low for decades. So all these people who were selling their silver bars back in the 80s and 90s were basically kind of scraping the bottom. And then we're out of the market when it began rallying again after the year 2000.
Yeah, and tell us about the central bank demand for silver, but also gold. Like you got this fascinating chart. We can put it on screen showing that basically central banks sold gold at a very low price, $200 $300, like in the 1990s. And now that the price of gold is so much higher, they're buying it. So central banks either are very bad traders, or they more likely, in my view, they don't have the outlook of trying to make money from these things. They're shooting their goals in other ways. So talked about that central bank demand for precious metals.
Yeah, so central bank demand has kind of varied over time. The central banks were buyers of it back in like 1979, 80, and 81, around the time it peaked. And then from 1982 to 2007, they were net sellers just about every year. And so the sort of reigning philosophy was they seemed to adopt John Maynard Keynes's viewpoint that gold was a barbarous relic. Um, and you may as well sell the gold reserves and then invest in dollars or euros or some kind of currency that's going to pay interest. But the problem is, once the global financial crisis hit, a number of things happened. First, interest rates hit zero, so they stopped paying interest. Secondly, countries began, particularly the U.S., began, and some to some extent, the EU began to use sanction regimes against other countries more and more aggressively over the last few decades. And then on top of that, everybody's been running huge budget deficits. A lot of countries have been doing quantitative easing. We've seen interest rates hit zero. And so this kind of created this demand on the part of central banks to hold assets that their peers cannot print and cannot sanction. And so central banks became net buyers in 2008, and they've been net buyers ever since.
Mm. And is there something new about the pace of central bank purchases over the past few years? Because we had a bear market in precious metals from 2012 to 2016.
Yeah, that's a good question. I would say my answer is maybe a little frustrating. It depends how you measure it. If you measure it in dollar terms, the amount of dollars that central banks are deploying to purchase gold has been soaring along with the price. But if you measure it in terms of the number of ounces of gold that they've been buying, it's been kind of relatively consistent, kind of hovering around 10 million troy ounces per year. Which is actually a lot. It's about 10% of global mining production is being purchased by central banks to store in their reserve assets. Um, but the problem is a lot of them would probably like to buy a larger number of troy ounces, but that becomes really expensive when the price, suddenly hits $4,000 an ounce.
Mm. And Eric, I've read maybe one or two Bloomberg articles this year about a silver shortage, particularly in the physical traded markets. How much are you paying attention to that?
It's a little bit beyond my wheelhouse. As a macroeconomist, I tend not to get that deep into the nitty gritty. We've been hearing about shortages, or at least deficits anyway, of a lot of different kinds of assets that trade on exchanges. Or a lot of different metals, platinum, palladium, silver, all seem to be in deficit.
And so looking at all the metals, I guess not just precious, but industrial, which metal is in the most deficit? Maybe not in terms of number, but in terms of like percentage or however you define it.
Yeah, I think palladium appears to have a pretty big deficit. The palladium situation is complicated. The inventories are pretty high, but the demand is stronger than the supply. So the inventories are high, but they're coming down fairly quickly. So I think that might be one to look at. And palladium prices have had a massive rally over the last few months. They kind of rose like 80 or 90% between early April and mid-October before consolidating a bit.
And so palladium and platinum are both used in traditional internal combustion engines, and that's why they've been in a bear market. But now that's reversed.
Yeah, and so they're used differently. So platinum is used in the catalytic converters of diesel engines, and diesel engines have been out of favor for a long time. So platinum peaked actually in 2007. And so it's been kind of underperforming now for the last 18 years or so. By contrast, palladium is used in the catalytic converters of gasoline engines, and gasoline engines up until recently were much, much more in favor. Um, and so as a result, palladium prices peaked really just a couple of years ago, back, I think in 2021 and 2022. Now, what's been causing some weakness in that demand, though, is a shift towards electric vehicles that we've been seeing in many countries around the world, led by China.
hmm And do uh, so platinum and palladium are both precious metals, and they actually are rarer than gold. But they no one's like no central bank is buying palladium, right, or platinum.
No, no, and part of the problem is that the mining production is so tiny. Um, the mining production of these metals, something like 7 million troy ounces per year, 8 million troy ounces per year in a good year, compared to 100 million for gold. The gold mining supply is literally 15 times bigger. And then part of it is also just tradition and history. Gold has been an agreed upon monetary asset, for 5,000 years. And part of the reason I think is because it has a very distinct color, where platinum and palladium, frankly, don't look really a lot different than like stainless steel, even though they're much more rare and much more valuable.
Are you a sophisticated investor concerned about today's markets? With the ever present potential for stock market corrections and the risk that bonds won't provide the hedge that they used to, You may want to consider adding an asset class that has historically offered stability when you need it most. The prices of agricultural commodities such as corn, wheat, soybeans, and sugar typically move to their own rhythm, driven by factors like weather and geopolitics, not the factors that move more traditional assets like stocks and bonds. Since inception in 2012, every time the S&P 500 has had a correction of 10% or more, the Teucrium Agricultural Fund Benchmark Index has outperformed. Getting exposure to agricultural commodities has always been tough for individual investors, and while it's not possible to invest directly in this index, Teucrium offers ETFs designed to give investors price exposure to these markets. If you're a professional investment advisor or a self-directed investor managing your family's wealth, click on the link below to learn more about how incorporating agriculture into your portfolio can help diversification and protection. Thanks for listening. Let's get back to today's interview. Eric, tell us about the rally in gold, which has been slightly less ferocious than the rally in silver, but it's a far bigger metal.
Yeah, so I would also add that it began a lot earlier than the rally in silver and the other precious metals. So it's kind of been going on for longer. But basically, there's three components to this rally, and it all has to do with fear. So first of all, almost every country in the world is running gigantic budget deficits. In the U.S., despite some tariff revenue at 6% of GDP, even with unemployment at 4.4%, to have a deficit that big with unemployment that low is very unusual in the US. Here in the United Kingdom, 4.5% of GDP budget deficit. In France, 5.5%. China and Brazil, 8.5%. You have other countries like Germany and Japan that Germany's traditionally had small deficits, now getting bigger because they're plowing huge amounts of money into national defense and infrastructure. Japan has colossal levels of debt in a fairly large budget deficit that's now going to become bigger as the new prime minister wants more fiscal stimulus. So the thing is, all of these governments are running huge deficits, and it doesn't seem to matter what kind of government it is, if it's in a one-party state, two-party state, parliamentary, presidential. No politician has any plan to do anything about this. Nobody's telling their citizens they have to pay hugely higher taxes or accept massive spending cuts. Um, Secondly, around the world outside of China, almost every other country on the planet has inflation running above target. And then third, despite above target inflation, almost every central bank on the planet outside of Brazil and Japan is cutting rates. And so people are looking at this and are saying to themselves, okay, wait a minute. Government spending is out of control worldwide compared to revenues, and nobody's doing anything about this. Inflation's above target, and the central banks are easing policy. So investors are concluding, okay, we want assets in our portfolio that central banks cannot print. And the thing is, the amount of equity and bond assets around the world is huge. And so even if a tiny portion of that gets reallocated to precious metals, which are much smaller markets, can cause a huge move in prices, and gold has been the leader in that regard.
Eric, everything you said about very large government deficits is true. Inflation being above target is true. But I would say it probably was also true from, the summer of 2020 to the fall of 2022, and there the prices of gold went down. So I'd say what is different about this environment maybe than during that not a bear market, but a period of stagnant prices from the summer of 2022 to the basically the next base before we shot higher in gold to the fall of 2022. Basically, how is this period different, and what are you seeing going forward? And I guess maybe is the issue expectations and relative expectations.
Yeah, so I would compare it actually, the current period, I was comparing in some ways to more like late 2018, 2019, and early 2020. So what happened then is at the end of 2018, the interest rate markets, our Fed funds futures, were expecting the Fed to raise rates from 2 3/8% to 3%. Instead, the Fed turned around and lowered rates in 2019, and then, of course, slashed them to zero at the beginning of 2020. And so gold during this period went from $1,200 to $2,100 an ounce. Then, as inflation began to materialize as a result of the massive COVID stimulus, short-term interest rates went from 0 to 5%, which suddenly made fiat currency, the US dollar, as well as its peers around the world, which did similar rate hikes, become much, much more attractive. And so gold kind of anticipated the inflation in advance. It rallied from late 2018 to like mid 2020. But then when inflation actually struck, it caused interest rate expectations and later interest rates themselves to rise. And so the market kind of consolidated during this period of high inflation. But now, what the market, I think, is telling us is that investors are very worried that we're now going to see a second massive wave of inflation sometime later this decade. Now, the problem for investors is that when that inflation wave arrives, if it arrives, um, then presumably interest rate expectations will rise and central banks will eventually have to tighten policy. And so gold will be sort of like Cassandra in the Greek myths, sort of like somebody who warns people something's going to happen and then nobody believes them and then gets no credit when it actually does happen.
And so the gold has a negative correlation to interest rates, and I'd say real interest rates, inflation adjusted interest rates. So interest rates and real interest rates shot up in 2022. That was bad for gold, and it happened in terms of the forward market in 2021 as well. Okay, I get that, but real interest rates are still quite high relative to the past decade over the past 2 years when we've had this bull market. How do you interpret this divergence where real interest rates haven't gone down that much, and yet gold has gone up by so much?
Well, I think it depends on what country you're looking at first. So let's start with the US, which is the most important because it's the global reserve currency, and gold and silver and these other metals are typically priced in dollars. Um, so over the last couple of years, US core inflation has stabilized at 3%, which is a percent above the Federal Reserve's target. At the same time, the Federal Reserve has brought interest rates down from 5% now down to 5.5%, now down to around 4%, and is widely anticipated by the markets and by the consensus view of economists, as well as by the Federal Reserve's own dot plot, to reduce rates down to around 3% by this time next year. But the question is, will inflation cooperate and actually decline as well? And the answer to that question is not entirely clear. But so far, we've been seeing a lot of stickiness in prices that continue to edge upwards in services, and perhaps now soon in goods prices as well. Um, so, and you look around the rest of the world, the Federal Reserve has actually been cutting interest rates much more slowly than most other central banks have. Like the European Central Bank has done many more interest rate cuts than the Fed, as have most of its peers. And inflation in these countries is also above target, and on average, over the last 6 months, it's headed a couple tenths of 1% higher. So, kind of globally, we have seen some decline in the level of real interest rates.
And because other central banks have cut more than the Fed, those other foreign currencies have been quite weak to the dollar. So I think, Eric, for listeners here who have an American dollar centric view, they when they look at the gold price in dollars, they might not be aware just of the strength of this precious metals rally, because like if the gold price of gold priced in Japanese yen or in euros is it's up way more, even more than it's priced in dollars.
Yeah, that's right. Yeah, I mean, so the weaker the currency, the higher the price of gold would seem from their perspective. What's interesting to me is when you look at the options market, precious metals options have been becoming more and more expensive. The implied volatilities on them have been rising. The opposite is true in the currency markets, where we've seen some of the lowest volatility on record. Some of the currency pairs like euro, US dollar, the least having the least volatile months we've seen in over 30 years. And so I think the problem is investors are looking around the world. They're looking at the renminbi, the euro, the pound, the yen, the dollar, et cetera, and they can't tell one from the other because all these countries are running huge deficits with no plan to do anything about it. Their interest rates are above, are falling, and the inflation, for the most part, outside of China anyway, is running above target. And so people can't differentiate between the currencies, but what they can differentiate is between fiat currency and stuff the central banks can't print, like gold.
Eric, moving on from precious metals, what is your overall macro outlook, and what do you think matters? What do you think doesn't matter?
Okay. So I think there's kind of three big narratives that are dominating markets right now. So we've talked a lot about the inflation narrative. I think it really is going to be very interesting in the US to see how the Federal Reserve shapes up next year in terms of who's running it, and what they wind up doing with monetary policy. The same thing for central banks around the world. I think it's going to be very, very interesting to see if all these interest rate cuts that we've had over the last year and a half around the world produce higher rates of economic growth. If they do, that could be potentially inflationary. Um, and so I think that inflation in that regard is going to be a very big issue. The other two narratives are Gen AI, which, in addition to boosting certain equity prices to astonishing levels, is also creating a lot of demand for electricity, so potentially creating a lot of demand for natural gas and for the copper wiring necessary to run these generative AIs in data centers and feed them energy. And then lastly, there's this sort of narrative of China. China's economy has been growing very slowly, which has been depressing the price of lots of other commodities like crude oil and crop prices. But at the same time, the one thing in China that's doing really well is electric vehicles. And that also implies a lot of demand for copper and a lot of demand for the electricity generation energies like wind and solar, which can involve some use of silver and certainly a lot of use of copper, as well as lithium and cobalt batteries.
And so you said, what is China doing that's depressing prices of commodities and agriculture commodities? Sorry.
So China, well, really two things. So first of all, the Chinese economy is growing very slowly. Um, yeah, the Chinese economy um, really reached its peak of growth around 2021. And so typically what happens is the price of crude oil and crops that are used for biofuels, like corn and soybeans in particular, tend to peak out about 1 year after China's economic growth crests. So China's economic growth got to a phenomenal rate in 2021. All of these prices peaked out a year later in 2022. Since then, China's been growing very, very slowly. And this is a problem for crude oil in particular because China imports 10% of global crude oil production each day. So now that their demand is really slowing down, that's bad for the crude oil market, and by extension, bad for biofuels. And then, secondly, China has been converting over to EVs at an astonishing rate. The average car lasts for about 12 years. 12 years ago, EVs were something like 1/10 of 1% of China's vehicle fleet. This year, the EVs will be a total of 55% of car sales in China. And so this is depressing demand for crude oil and for biofuels, but it's boosting demand for copper, for coal, and for natural gas.
Okay, so commodities tend to peak 1 year after the peak in Chinese growth. That's interesting. And so that was 2021, and then the commodity prices peaked in 2022. That makes sense. What's your outlook on Chinese growth right now? How does that outlook compare to the kind of vanilla Wall Street outlook on China? And also, just is this real estate thing done? Because I talked to a lot of people saying real estate prices have bottomed in China, real estate prices have bottomed. And then the other day, you get this Bloomberg piece about how one of the biggest property developers is asking for some debt forgiveness, or I think rather an extension, indicating that the issue is not over.
Yeah, I think it's going to be more of the same in 2026 would be my guess. And so the issue here is that at the turn of the century, the real estate industry in China was about 10% of Chinese GDP. By the middle of the last decade, it grew up to be nearly 30% of Chinese GDP, real estate, construction, and related activities. Now, this industry, according to China's own data, the construction industry um, is seeing negative 17.5% year on year growth as of the second quarter. So the amount of construction activity is contracting very, very rapidly in China. At the same time, China releases monthly data on home prices, and those have continued to slide. And in recent months, the pace of that slide, according to China's data, has accelerated. And this is a huge problem also for China's consumers. The average Chinese household has something like 68% of their net worth in their primary residence. In a country like the US or the UK, numbers would be maybe more like 25 or 30% would be real estate. So falling real estate prices have depressed consumer spending. And so the strategy has been to boost industrial output, primarily of electric vehicles, solar panels, things of this nature, as well as other industrial items, and to either consume them domestically or build them out domestically or to export them. And so I think that there's nothing I've seen that changes any of these trends at the moment.
Okay, nothing that changes the negative trend of Chinese real estate. What about the positive of this huge, boom in industrial demand of electric vehicles and other stuff? I mean, I think it's a positive thing to say that the Chinese economy has averted disaster as you've had this mega implosion of the real estate bubble in China, perhaps one of the biggest real estate bubbles ever. Like, I think the American economy would have done far worse if it had the level and implosion of the real estate bubble, as we did in 2008, 2009. Um, just tell us, is the Chinese economic model of providing this stimulus of exports production? It's basically just the government instructing banks to make very large loans to production. Do you expect that to continue, and could we see a pickup in that level of activity?
Well, yeah, I think you're right. I mean, China's economy is very impressive. Despite the problems in the real estate sector, the economy continues to grow at 3 or 4% year on year, which is not bad. Maybe even 5% year on year, which is pretty good growth. Um, but I think that there is a risk there that the world runs out of appetite for some of these products. A lot of countries have been reining in incentives to buy EVs. There's been sort of a backlash against EVs in Europe and certainly in the United States, where the subsidies basically all expired on the 1st of October. Um, so it could be that the world encounters a glut of electric vehicles on the market. Um, and it kind of creates some problems for China's exports. You have a problem of overcapacity in some of these industries. So it is not without risk.
And a lot of that overcapacity is exported to the rest of the world. Certainly in the United States, we're familiar with that. Is Europe more vulnerable? Because I believe you never see a BYD or a Chinese electric vehicle in America, but I know they're just like everywhere in Europe.
Yeah, apparently the best-selling cars here in the United Kingdom. Um, and I think that there are risk of potential backlash in Europe because Europe has massive automotive industry. Um, and I'm sure the Europeans don't want to see their automotive industry get sidelined either domestically or internationally. So I don't know exactly what will the response will be, but it would not surprise me to see the sort of global uptick in protectionism coming to Europe as well.
And what about China impact on agriculture? I mean, I know China buys a lot of soybeans to feed the livestock and such. What's your outlook there?
So China's back in the market. They've been buying again in the last month. They essentially agreed with the administration in the U.S. to buy, a certain quantity of soybeans from the U.S. going forward. We'll have to see how that evolves. But China, about 7 or 8 years ago, at the time of the first sort of increase in trade tensions, really diversified their supply lines to include a lot of buying from Brazil. But as Brazil sells more to China, it means that they sell less to the rest of the world. So the rest of the world buys more from the U.S. So the supply lines have kind of shifted around into ways that may be, from a distance perspective, less efficient because, Brazil is basically on the opposite side of the world from China, and the soybeans have to transit the Suez Canal, so they take a long time to, or the Panama Canal rather, so they take a long time to get there, which probably adds a little bit to the cost basis of them. But I think that the soybean market, above all, along with corn and even wheat, is very, very closely connected to the price of crude oil through the biofuel market and also just through the energy intensive nature of farming. So I think that all of these markets remain deeply intertwined, and it's really hard to sort of disaggregate agriculture from energy.
And so energy prices have been low, oil prices have been low, and therefore agricultural prices have been low too.
Yeah, that's right. And when it comes to oil prices, you have not only weak demand, but now OPEC has increased production over the last 6 or 8 months or so. And U.S. production of crude oil just hit a record high last week at 13.9 million barrels per day. So the price discovery that's taking place through the WTI market, West Texas Intermediate market, is very, very important globally. The energy market's very well supplied at a time when demand is not phenomenal.
You said so. U.S. production hit a high, or Permian production hit a high. Which one?
Well, U.S. production overall hit a high of 13.9 million barrels of oil per day a few weeks ago, which is the highest it's ever been. It's not up a great deal. Like a year ago, it was at 13 and a half. But the fact that it's been continuing to rise, even with prices this low, is a sign to me that the cost of fracking are really not all that high, and that the producers are still willing to invest even at these price levels.
Yeah, Eric, what is it about so many of these analysts that they keep on projecting peak Permian production, peak Texas oil production, and yet those drillers in Texas just continue to drill, drill, drill. They do it under Republican administrations, they do it under Democrat administrations, and it just seems like, what is this source of this relentless forecast of Permian production, peak Permian production that you've seen every month, I'm sure, for the past 10 years?
Yeah, well, one thing that's interesting is unfortunately, they've discontinued the data, but up until about the middle of last year, the Energy Information Administration used to produce this monthly report called the Drilling Productivity Report, where they looked at how much oil was coming out of the ground in 7 different regions versus the amount of equipment. And the amount of oil that comes out per rig has been soaring. So this is a technological revolution, and I think a lot of people sort of have this constant view of the level of technology. Well, it can't get any better, but it keeps getting better. And so as a result of that, you wind up with higher and higher production. And you see that somewhat in the agricultural space as well, where per acre harvested yields continue to rise as technology on the farm continues to improve.
Yeah, and that's such a good point, and the way that you look at it of the amount of oil produced per well has soared. That's extremely very very shows that supply is going up. That's, I think, the correct way to look at it. A lot of people view it the other way and say, "Oh my God, the rigs have gone down," but the reason they've gone down so much is because that the oil per rig has gone up by so much.
That's right. Yeah. And so, yeah, you can't, you, without using that multiplier, you really miss the big picture.
Yeah. And, okay. So productivity for oil has continued to go up. Tell us about productivity for agricultural productivity, because I'm sure you're right that it has gone up over the past, let's say, 10 years. But the real like boom in productivity was like from over the past like 100 years, right?
Yeah, well, it kind of continues and fits and starts. And so there was this period a few years ago. I can't remember, maybe about 2016 to about 2021 or 2022, where it looked like around the world the yields per acre had kind of plateaued, but then they started to rise again in the last in the last 2, 3, 4 years to new record highs. And so I go to a lot of conferences with farmers, and some of the developments in terms of equipment are just mind-boggling. So you can now use drones on your farm to figure out exactly what parts of the field need watering and which parts don't. So rather than just watering the whole thing, you just put the water only onto parts where it's actually needed. Um, there's also tractors that have these large burns going out of both sides of them. Each one has a sort of digital camera like you would have on a cell phone, and they look at each plant and decide whether that particular plant needs to have fertilizer or pesticides put on it. So instead of spraying the entire field indiscriminately, you do everything much more judiciously, sort of growing everything on a plant by plant basis almost in a way that uh, individual humans wouldn't have the time to do and traditional farm equipment wouldn't have the intelligence to do. Now, this farm equipment is imbued with a level of intelligence that is allowing us to further increase output per acre.
Wow, that's very interesting. So, Eric, if during 2022 the obvious narrative, the obvious cause of the huge surge in oil prices was Russia's invasion of Ukraine, and both the fact that the actual oil supply was disrupted, but perhaps more importantly, the the uh, the the fear priced in that the oil actually would be disrupted, and therefore a lot of people speculating on the price going up, which caused the price to go up. That was the main driver. What's been the main driver this year where you just had kind of just a slow grind down since June? Has it been OPEC, or is there something else?
Well, there's always a lot of different factors, but the one thing I would point out about oil prices in 2022 is the prices began soaring a long time before that. The price of oil really began soaring in 2021. It happened to peak in 2022 after Russia invaded Ukraine. And I have no doubt that invasion and the fears around it to potentially disrupt the supply push prices further than they would have gone anyway. Um, but it's also worth pointing out that the world was reopening from COVID in 2021. And during the pandemic, people couldn't spend any money on services. Like we weren't traveling, we weren't going on vacation. So everybody shifted all of their spending into goods. And where are the goods made? They're made in China. So China had this unbelievable growth rate in 2021. Their in energy demand in China was surging in part because of the global demand that was related to COVID. And that sent the price of oil, natural gas, corn, wheat, soybeans, industrial metals, battery metals, everything just soaring into the second quarter of 2022 after that Russian invasion. Since then, China's slowed down a lot. We've realized that the Russia Ukraine war is actually not, thankfully, particularly disruptive to oil or agricultural commodity supplies, a little bit, but not too much. Um, and so, all the prices have come back down. And then on top of that, you have burgeoning production of oil, natural gas, battery metals, as well as now agricultural goods, all seeing their production increase. So this is kind of the perfect storm for weak commodity prices outside of the precious metals sector.
And Eric, do you think so? So the oil is well supplied now. I think you said something to that effect, or maybe the exact quote that oil is well supplied. Do you see oil being well supplied for the near future? And I mean, could we see $40 barrel oil, $30 barrel oil?
I mean, it certainly is conceivable. Like in the US, as we mentioned, production's at a record of 13.9 million barrels per day. As we alluded to earlier, OPEC's been increasing production a little bit. After oil prices peaked in 2022, OPEC took about 2 to 3 million barrels of oil off the market every day. Uh, and so that really even didn't support prices particularly as much as OPEC expected. And so I think then the OPEC members, led by Saudi Arabia, they got tired of losing market share. And they kept saying, okay, our market share keeps shrinking and we're still not supporting the price of oil. So they're on this kind of catch 22, where they could increase production further, quite a lot further, and maybe cause the price to crash like it did in 1985, like it did in 2014 and 2015, like it did during the pandemic, and gain market share. Or they could continue to shrink their market share and support a price of oil that's still not spectacular at maybe around $60 or $70 a barrel. So their actions at the moment seem to be kind of in the middle of that. I would not exclude the possibility of oil going down to below $50 a barrel at some point in the next year. I'm not saying that's going to happen. I'm not allowed to make price forecasts, but it would not particularly surprise me if that happened. Um, and as always, the upside risks in oil are mainly geopolitical. We've seen a geopolitical risk. We saw a conflict between Israel and the US and Iran this summer. And then we still have the traffic through the Suez Canal essentially reduced by about 85% because of the insurance companies' lack of willingness to extend insurance, given the actions of the Houthi rebels in the Yemen. And none of this seems able to keep oil prices much above $60 a barrel.
And how does Venezuela come into this? I know Venezuela has the largest oil reserves in the world. It's not the largest producer by any means, but in terms of reserves, technically they have the most. Could what the U.S. is engaging Venezuela right now? eh, Do you think that could affect the oil price?
I would say, I mean, it could, but I would say probably not very much. Venezuela's production has collapsed under Chavez and Maduro. It went from maybe 3 million barrels a day 25 years ago to, I think, less than a million barrels of oil per day now, maybe even like half a million. So they're kind of like around 0.5% to 1% of global supply. So even were that supply or those exports to be interrupted, I don't think it would have a huge impact on the global price. It could have some impact, but not a lot. Um, the other thing I would point out is that, when we had this conflict in the Middle East this summer, the various parties were very careful not to target any oil infrastructure, in part because politicians in the world don't want higher oil prices. My guess is that, if were there to be any sort of hostilities, it would probably not target oil infrastructure.
That makes sense. What do you think is something that affects oil prices, affects oil, but is underfollowed? Like a lot of people know about OPEC. A lot of people are thinking about electric vehicles, but what is something that's underrated by maybe oil tourists?
Well, I think the biggest thing that's underrated is the impact on fluctuations in China's demand. We talk a lot in the oil market about who is the swing producer. And so the debate is always, is it Saudi Arabia or an OPEC? Is it Russia, or is it the frackers in the United States? And the truth is, it can really be any of the three of them. But nobody ever asks the question, who's the swing consumer of oil? And Chinese oil consumption over the last several decades went from about 4 million barrels of oil per day back in 1990, when China was a net oil exporter, to around 15 million barrels of oil today. So China is really the dominant consumer that's driving the price on the demand side. And what happens in China is partly a reflection of what's going on in China domestically, but China is also very sensitive to the state of the global economy and people's demand for the kinds of goods that China's exports to the rest of the world. And then, of course, as we mentioned, the nature of those goods is also changing as China has become the global leader in the energy transition, moving faster towards solar energy and EVs than any other country on the planet.
How does President Trump's tariffs impact your global outlook for economic growth, and particularly the US, as we sit here in December 2025, looking forward to 2026?
It's a tough question. I don't really know because I don't really know exactly where the tariffs are going to settle. They've been changing a great deal. I think in some ways it's an easier answer a question to answer in terms of like how does it impact China? And I think the answer is surprisingly small. If you look at the amount of Chinese exports to the U.S., it comes to around 3% of Chinese GDP. So even if the tariffs were to reduce that to say 2% of Chinese GDP, maybe that shaves the point off of Chinese growth, which isn't maybe great for commodities. But it still leaves China's economy growing at maybe 3 or 4% instead of 4 or 5%. Um, so, I think it's kind of country by country basis. But what I would say is a sort of global rise of protectionism, not just in the US, but also in many countries around the world, creates um, probably a somewhat more inflationary environment in which trade frictions increase um, and investment gets rerouted around the world. So instead of putting all the investment in the cheapest, least cost producer, people are now onshoring and nearshoring production. And all of this kind of contributes to potentially higher costs in the economy and higher inflation, not just in US, but all around the world.
And Eric, how would you summarize your overall economic view? What are the risks in 2026? Are they skewed to the upside for inflation, or are they skewed to the downside for a slow growth recession?
So I would argue, and this I feel like I'm going on a limb, and I could be very well be wrong, but I'll say this. My feeling is that the economic growth rates are likely to improve in 2026 because of the massive global easing of monetary policy. And if growth rates improve at a time when inflation's already running above target, just about everywhere in the world, with a few exceptions like China and Switzerland and Singapore, um, that we could wind up seeing higher inflation next year. There's a lot of variables, but I would say maybe a little bit to the upside economic growth as a result of this massive monetary policy easing.
And almost all central banks are easing. The one that is tightening is the Bank of Japan. How big of a deal is that, you think?
Okay, so Japan's economy is important, but it's in some ways a very unusual economy. And so it's true that the Bank of Japan is tightening policy. It's also true, however, that the policy rate at the moment is 0.5% at a time when Japanese core inflation is still stuck up at around 3%. So the real rate of interest in Japan is negative 2.5%, which means that basically the Japanese central bank continues to subsidize people who borrow in yen, whether they're Japanese or not, for the act of borrowing money. And so what we've been seeing in Japan recently is that we've been seeing a very sharp rise in yields and therefore a very sharp fall in Japanese government bond prices.
Mhm.
Um, so one of the potential issues is it could feed through to the rest of the world, and we could see higher long-term bond yields in many countries um, because countries compete against each other in the global capital markets to raise capital for their governments. And so if the Japanese are willing to pay more and more and more and more money to issue 10-year and 30-year debt. Eventually, investors could say, okay, you know what, fine, we'll buy more JGBs and less treasuries or less French OATs or less British gilts. And you could wind up seeing long term yields drifting higher. And in fact, not to the same extent, but we're seeing long term yields drifting higher in Australia and France and Britain and Germany and many other countries. So far, the US has been kind of immune from this, but that could change next year.
And Eric, I want to close. I want to ask you: is how does AI? What are the commodities that are in demand most and needed most by AI and the data center expenditure build out?
Okay, so the data centers specifically use primarily copper because they all have to be wired up to the electric grid. And then secondly, they use inordinate amounts of electricity, which is primarily in the United States being sourced by natural gas. Now, in other countries, the answer is a bit different. In China, it would be more coal than natural gas, much more coal than natural gas. But China is also building out gigantic solar farms. And the solar panels use silver. They have to be wired up using copper, and then because the power is intermittent, it may also be increasing demand for lithium and cobalt, which are two key ingredients in batteries as well.
And does the chips themselves use any metal in any large scale other than copper?
Um, and not to the best of my knowledge. I know that they use certainly a lot of silicon, which of course isn't really traded on exchange that I'm aware of. But they use certainly a fair amount of copper, and they also use a lot of rare earth minerals too in some of these chips that are not traded on exchange. But I think that yeah, I think that the chips themselves. Aside from copper, are largely kind of outside of the domain of exchange traded commodities.
Mm. Okay, that's interesting. Um, Tell us about supply of those metals. So copper, lithium, and cobalt. What does the supply outlook look like there?
Okay, so copper supplies have been among the slowest growing of all of the metals. And so part of the problem is a lot of the copper in the world is mined in Chile. Chile's mines production has kind of plateaued. So on a good year, you might get like a 4% increase in the global supply of copper, more typically more like 1 or 2%. So this massive increase in copper demand is colliding with an excessively or exceedingly slow increase in mining supply. That contrasts very sharply with lithium and cobalt. Lithium supplies in particular have been soaring, um, from around maybe 4,000 metric tons of lithium 35 years ago to now hundreds of thousands of tons today. Some years it grows by 15, 20, 25% per year. Cobalt's been a little bit less strong. The main difference between cobalt and lithium is cobalt supplies are very concentrated in one country. Like 76% of the production is coming from Democratic Republic of Congo. And so they recently have been putting on production and export restrictions. And so the price of cobalt has been rising a little bit. That shouldn't have too much of an impact on battery prices because cobalt is a fairly small component in batteries used mainly in the catheters. Um, but lithium prices have also just started to creep up again in recent weeks. So I would say that those are kind of the main ones. And then other commodities like aluminum and steel grow at a steadier pace, but are not particularly impacted by Gen AI.
Okay, lithium and cobalt supply actually has been growing a lot. That's very interesting. Copper supply has not been growing as much. Is there a copper shortage? Because a lot of economists have been talking about copper shortage, copper shortage, copper shortage. And admittedly, the price of copper has gone up a lot, but you're not really seeing um, that huge imbalance that has been predicted. Or maybe you are. You tell me.
Well, yeah, I mean, I think the price rise is somewhat reflective of some degree of imbalance. And what's interesting to me is if you overlay the price of copper historically, going back at least 20 years or more, on the price of West Texas Intermediate crude oil, up until October 2022, they did just about the same thing. When oil prices were high, copper prices were high, and when oil was low, copper was low. Then 3 years ago, they started to diverge in a really big way. And so, what this tells me is the inexpensive price of oil has caused the cost of copper mining to fall quite a lot because it's very energy intensive. Nevertheless, the copper suppliers have still found ways to charge more and more money for their product because the demand is so high.
Hey, Eric, that's interesting. You did see that with, I'm sure, copper miners as well, but I noticed it in gold miners. Like in 2022, gold miner profitability just collapsed because it was so energy intensive and they were just spending so much on oil and natural gas.
Yeah, now I think the mining industry is in a phenomenal position. Not all of them, it depends what metal they're mining. I think gold and silver are super expensive. Their prices are really high. Copper prices are very, very high. Platinum and palladium prices have come up quite a lot, and our energy costs have fallen dramatically. And now you're also starting to see the same kind of maybe cusp of a technological revolution there too. We recently heard that Elon Musk is developing robots that can do mining, which is also a very interesting development from one of the world's most dangerous and I think, frankly, you know, most probably least attractive professions.
Yeah, that's interesting. I had no idea about robots doing mining.
It's in its infancy, but it's kind of more being discussed. But it could definitely happen, which could be interesting news because it takes so long to get new mining projects approved. And even if you were to discover a new source of copper today, by the time you get all the permits and dig the mine and start producing, it could be the year 2040 or 2045. It can take 15 to 20 years to start bringing it out of the ground. So anything that can be done to sort of expedite that process could, over some long period of time, have a big impact on supply. So if we're talking here in 2035 or 2040, we could be having a very different conversation on the supply side.
Yeah, let's close out looking at long term. It is the people who predicted peak oil in the 1970s and 1990s that they ended up looking, very wrong. Oil production is at an all time high now. Um, but what commodity, let's say in 50 years, looks like, we're in some trouble. We need to figure out to move to a society where we don't consume this much because it just doesn't exist.
Yeah, I don't know that any of our commodities will cease to exist. I mean, 50 years is a long time horizon. I'll be 101 years old when that happens. But
I'll
Um,
interview you
I
that.
I would say the one commodity that's probably gonna see the biggest changes might be crude oil, but I don't think it's gonna disappear, let me tell you why. So, on the one hand, yes, ground transportation is in the early stages of a massive change where people are moving over towards EVs. That will largely be powered ultimately by maybe nuclear power, by natural gas, by solar, by wind, by geothermal, hydroelectric, et cetera. Um, on the other hand, the world still needs plastics and it still needs all the materials that come out of crude oil. So even if you get rid of crude oil from a ground transportation perspective, you'll probably still use it long into the future for air transport, and then also even further into the future for various materials. A lot of the medicines we use, a lot of the uh, pesticides we use, a lot of the products around our houses are made out of various polymers, including clothing. I just look around the office, the desk, the notepad, parts of my computer, all sorts of stuff is made out of crude oil. My telephone is made out of, this clearly here is made out of crude oil. Um, the range
That
of
may be
use
clear
is
to you,
really
clear and obvious
enormous.
to you. It's not clear to me, but yeah.
Yeah, yeah. I think there's so many products that, even if you decide to stop using crude oil to generate energy for ground transport, it will just change the nature of what it's being used for.
Eric, we'll leave it there. Thank you for joining us. Where can people find you on LinkedIn at cmegroup.com and tell us about the kind of research that you share with the public?
Yeah, so we all of our research that we share with the public is on cmegroup.com. It's kind of at the bottom of the page. We have an economic research section where my colleague Mark Shore and I put out papers on a fairly regular basis and also put out a lot of videos. Um, and so anybody can access that for free. And then we're also on LinkedIn, et cetera.
Thank you, Eric. Thank you, everyone, for watching. Please leave a rating and review for Monetary Matters on Apple Podcasts, Spotify, and also subscribe to the Monetary Matters YouTube channel. Thanks. Thanks for watching. Remember to click the link in the description to learn more about the Teucrium Agricultural Fund Benchmark Index. Until next time.
Thank you. Just close the door.